Welcome, everybody. Thank you for joining us for a guide to understanding flood insurance. My name's Mary Ann Rothman. I'm the Executive Director of the Council of New York Cooperatives and Condominiums. Presenting this evening, we have a group of experts from Mackoul Risk Solutions. Unfortunately, Ed Mackoul, the CEO of the company, has been called away on a personal emergency. Everyone's doing fine, not to worry. But Gabrielle and Cheryl are jumping in to fill Ed's shoes in this presentation. Justin, I think we have your biographical information on the next slide. There you are. You've been with Mackoul Risk Solutions since 2013. You have over 10 years experience in the insurance industry, and you specialize in finding high-risk homeowners comprehensive flood policies. So you are the perfect authority for tonight. Mackoul Risk Solutions as a company has been insuring co-ops and condominiums and homeowners for over 30 years. They also provide insurance to the owners in the building, as well as the property management firm and employee benefits for all size entities. This year's hurricane season is expected to be an active one. Hurricane damage is typically a covered peril, but flood isn't, either for co-op or condominium owners. Our Mackoul experts will be discussing what is flood insurance, who needs it, and how flood rates are determined. In addition, they'll discuss the advantages and disadvantages of private flood carriers, which is a recent alternative option to the typical national flood insurance program. How much coverage should a co-op or could a co-op or condominium attain? Should a co-op condominium unit owner have flood coverage? And can a shareholder obtain flood on their unit? But a few housekeeping measures before we get started. We're going to keep all participants on mute, but if you have questions during the presentation, please type them into the Q&A box at the bottom of your screen. We've allotted some time for questions at the end of the presentation. And if you have questions that we don't manage to answer, we will get back to you by email with our best attempts at answers in the next couple of days. Second, you will all receive a recorded version of this webinar within the next few days. And finally, just by attending this live webinar, you are entered to win a $50 Amazon gift card sponsored by Mackoul Risk Solutions. The winners will be announced later this week via email. Gabrielle, Cheryl, and Justin, let me turn this over to you.
Mary Ann. As Mary Ann mentioned, my name is Justin Kraus. I am the personal line supervisor here at Mackoul Risk Solutions. We have been really getting heavily involved in flood insurance for the last 2 years, especially because of where we're located on the south shore of Mackoul County. So I think when Mary Ann reached out, it was a great time to do this presentation, mainly because we're now in the beginning phases of hurricane season, and based on NOAA and all the actuaries, it seems like it's going to be a very busy one. So just some facts right now. According to AccuWeather, the 2020 hurricane season was responsible for over $60 billion in economic damages. 2021 is expected to be another active storm season. This year, they're predicting about 13 to 20 named storms, 6 to 10 hurricanes, and 3 to 5 major hurricanes. The official start of the Atlantic hurricane season is currently running in June 1st and runs through November 30th. Up here in the Northeast, we tend to get hurricanes later in the season, but it seems like there's already been 2 tropical storms that have spun up off the Northeast coast. So it seems like we're right on track to what NOAA had mentioned. So what is considered a flood? Flood, as defined in a flood insurance policy, means a general and temporary condition of partial or complete inundation of 2 or more acres of normally dry land area, or 2 or more properties, one of which is your property, from overflow of inland or tidal waters, unusual and rapid accumulation of runoff or surface waters from any source, and mud flow. Definition in a commercial package policy can often and is different. It will specify to the locations indicated on the declaration page and does not require 2 or more acres or 2 or more properties to be inundated. And I think Gabrielle and Cheryl can both confirm that having it built into your package policy is probably the most preferred option. How do you know if you're in a flood zone? Well, every property is in a flood zone. It just depends on if the property is in a high-risk flood zone or a low-risk flood zone. So some of the special flood hazard areas, which are the higher risk, are properties AE, A, AH, AO, A99, AR, VE, V, and VO. Non-special flood hazards, which are lower areas, tend to get a better rate, which are the D, C, X, and D zones. So basically, your property is in a flood zone. You have a lower chance of flooding being in the non-special flood hazard areas, but as a couple later slides we have it, that's still most properties, about 20% of properties that flood are already in those lower zones. So it's important to purchase flood insurance no matter what zone you're in. How do I obtain flood insurance? There are 2 different methods to obtain flood insurance. The first obviously being through the National Flood Insurance Program. You can purchase that directly, and that is the government-backed program. There are some companies that are the write your own flood company programs. Those are through companies like Allstate, Selective, Wright, American Bankers. Now those are still backed by the National Flood Insurance Program, but they pay these carriers a commission in order to service it. So at the end of the day, the money is still coming from the NFIP, but just being serviced by an Allstate or State Farm or Travelers. As of the last few years, another option has been private insurance. Those companies like Lloyd's of London, Indian Harbor, they've all been coming out with programs to offer private flood insurance. This can also be added on to a commercial property package policy as an endorsement. However, it cannot be added on to a homeowner's policy. There are some companies such as Kingstone that have been offering some flood endorsements, but again, you have to qualify and basically not be in one of the high-risk zones. And I think that's probably the same case with commercial as well.
Correct, Justin.
What is the maximum limit I can obtain with the NFIP? So this is for a cooperative building, commercial. That would be $500,000 in building coverage and $500,000 in contents coverage. Both are written on an actual cash value basis. Condominiums, the lesser of 100% of the replacement value of the building, including amounts to repair or replace foundation and its supporting structure, or the total amount of units in the condominium building times 250,000. One of the requirements is they must maintain at least 80% of the replacement value of the building, or the total amount of units in the building times 250. Many of these reasons are because of the co-insurance penalty. Content is up to 100,000 per building. Building is written on a replacement cost, whereas contents is written on an actual cash value basis. Cheryl, do you have any more information on the condominium aspect of purchasing insurance?
No, I think that you kind of covered everything there. It just has to be the, whichever is the lesser, either the 80% of replacement cost or 250 per unit, and it's either the lesser of either.
Great, thank you. What is the maximum limit I can obtain with the National Flood Insurance Program? So as of today, a homeowner or a condo owner can purchase up to $250,000 in building coverage and $100,000 in contents coverage. A condominium unit owner, like I mentioned, is the same. Now, a little bit different is that they can only purchase up to 250,000 minus whatever the master policy insures the unit for. So we would take that value of the master policy, divide that by how many units, and whatever the difference is, if it's not 250,000, is the most that a condominium unit owner can purchase. Now, as far as a shareholder in a cooperative, they're only allowed to purchase contents coverage up to 100,000, and 10% of that can be used for improvements and betterments. So that can cover anything in the unit, whether it be kitchen, bathroom, flooring, or fixtures, but it maxes out at 10%, which is traditionally $10,000. Coverage A, building coverage, condominiums. So this is what coverages are in a flood policy. The residential condominium building described on the declaration page at the described location, including all units within the building and the improvements within the units. We did include some hyperlinks, which will come out in the presentation where you can click on it for a little bit more detailed list of what exactly is covered. For cooperatives, the insured building and its foundation, as well as plenty of the items inside, but not improvements and betterments made by a shareholder. Again, we've included a link just for some additional information. And for homeowners, it's a little bit more comprehensive. The physical structure of your home and its foundation, plumbing, electrical system, central air, heating system, built-in cabinets, wall paneling, wall-to-wall carpeting, floor, kitchen, cabinets, bathrooms, and vanities. Basically, everything that is part of the structure of the home that is attached to the walls is what the building would cover.
So for condominiums, personal property inside and fully enclosed in an insured building, coverage for personal property includes the following property: air conditioning units, portable or window type, carpet not permanently installed, that would be area rugs, as long as it's not wall-to-wall carpeting, any type of area rug over a finished floor, and clothes, washers, and dryers. Again, we have a full list of what is covered with the hyperlink, which will be sent out in the presentation. For cooperatives, furniture and fixtures, machinery and equipment, other personal property owned by you and used in business. For homeowners, it would be personal belongings such as clothing, furniture, and electronic equipment, curtains, portable and Windows ACs, portable microwave ovens, clothes, washers, and dryers. Now, a lot of these homeowners' personal property also crosses over to the individual condo unit if they do have personal property covered on their policy. Some of the other coverages that are included is coverage C, which would be other coverages, debris removal. This coverage will pay the expense to remove non-owned debris that is on or in insured property and debris of insured property anywhere. Coverage D, which is increased cost of construction, otherwise you may see it on your policy as ICC, is insurers may receive up to $30,000 under this coverage to comply with state or local floodplain management laws or ordinance. Compliance activities include elevation, floodproofing, relocation, and demolition. There are some stipulations in order to receive this $30,000 for both condo buildings and your individual homeowners. The building has to be more than 50% damage from the value, or has to be, have severe repetitive loss. So it has to be more than 1 or 2 claims in the last 5 years. And those will satisfy the requirement to get you the extra $30,000 to pay for any of these additions to the home. Exclusions. So these are the exclusions on a flood policy from the NFIP. Loss of revenue or profits, loss of access to the insured's property or described location, loss of use of the insured's property or described location, loss from interruption of business or production, any additional living expenses incurred while the insured building is being repaired or is unable to be occupied for any reason. That's a big one, especially because most of the time you can't really live in a flood damaged unit or building, and you need somewhere else to live while you're still paying the bills of your current residence. So the cost of complying with any ordinance or law requiring regulating the construction, demolition, remodeling, renovation, or repair of the property, including removal of any resulting debris. This exclusion does not apply to any eligible activities that were described in the last slide we discussed, which is increased cost of compliance. and of course, any other economic loss. So these are in some important definitions that you'll see throughout a flood policy or while you're quoting, working with a broker. So basement is a big one. Obviously, homes with basements or condos with basements tend to get a little bit higher rate because they are almost proven to have a flood. The definition of a basement is any area of the building, including any sunken room or sunken portion of a room, having its floor below ground level on all sides. So even if it's not a traditional basement, a sunken living room or anything below grade is going to be considered to be a basement. Pre-firm building. Pre-firm buildings are those that were constructed or had substantial improvement prior to December 30th of 1974. These buildings may not conform to current floodplain management regulations. One of the benefits of the pre-firm buildings is that in most situations, they do not require an elevation certificate. The post-firm buildings, which is the next option, is a building for which construction or substantial improvement occurred after December 31st of 1974 or on or after the effective date of initial flood insurance rate map, whichever is later. Any post-firm building does require an elevation certificate in order to receive a rate from the NFIP. Usually, most elevation certificates are about $800 to $1,000. Obviously, with the larger buildings, they come more costly. I think Cheryl would know exactly how much those usually go, but
I agree. It runs depending on the building, but it could run, like you said, anywhere from like $800 to $1,000.
yeah, definitely something that is worth it, especially to have on file. Grandfathering building. Grandfathering is a national flood insurance program rule that was created to recognize property owners who carried a policy before the maps became effective or built to the correct standards relative to the flood map in effect at the time of construction. So grandfathering is huge and allows a lot of buildings and homeowners to actually take advantage of the lower rate because they were somewhat built in compliance, as they call it. Base flood elevation. You'll see these a lot on elevation certificates. The BFE is the elevation that floodwaters are estimated to have a 1% chance of reaching or exceeding in any given year. The higher your lowest flood floor is above the BFE, the lower the risk of flooding. Lower risk typically means lower flood insurance premium. The BFE is determined by a surveyor, and it makes sense. If the BFE of your home is above, if your home's elevation starts above the base flood elevation, then your risk of flooding is going to be a lot lower, and the insurance company takes that into consideration when setting your rate. Elevation certificate. So this basically determines your flood risk. So the correct definition is if your building is in a high-risk flood area, zone indicated with the letters A or V on a flood insurance rate map, the EC includes important information that is needed for determining a risk-based premium. For example, the elevation certificate shows the location of the building, the lowest floor elevation, building characteristics, flood zone, and base flood elevation. Especially as
if I could just jump in there, Justin, for a second. This is where they're going to find out what your base flood elevation is. That they're going to be the ones to have that number to know where it's going to flood and where your building sits. So that's why the elevation certificates are so important.
Yeah, and this is what every insurance company, the NFIP, is going to basically determine your rate on. They're going to determine what your lowest floor is. They're going to calculate where the machinery is in the building and take all that as far as flood vents and if the home is properly vented or the building is properly vented. So elevated building does not have a basement. Lowest elevated floor raised above the ground level by any of the above. So it would be foundation walls, which would be usually solid concrete, shear walls, which would actually are designed to break away during high flood surge, post, piling, piers, and columns. So all these are different methods of elevating your building, whether it be a home or a condo building. So as of October 1st, 2021, FEMA has come out with a new risk rating 2.0. It's been pretty popular. I think the New York Times released an article on Sunday about how this is going to impact mostly 5 million, NFIP policyholders. As I mentioned, it's supposed to take effect on October 1st of 2021. Risk rating 2.0 will determine flood insurance premiums based on a property's individual risk. The change in rating methodology comes as a result of increased flood risk due to climate change. Also beginning October 1st, existing policyholders are eligible for renewal will be able to take advantage of immediate decreases in their premiums. Now, FEMA has said that there's probably going to be about 20 to 24% of policyholders who will see a slight decrease. I don't think that that's going to be in our area. I think that's going to be in other areas, and also going to be with lower flood zones, such as the X and D zones. Unfortunately, I happen to think that this is just a way of FEMA getting to increase the rate with coming out, with a different rating method. As of right now, all homes in a certain community are rated the same. So if you take two homes on a street, whether one is, half a mile away from the water or, a mile away from the water, if they both have basements, you're going to typically see the same rate. So what FEMA wants to do with the risk rating 2.0 is they want to determine, does John's home or Sally's home have the same risk of flooding, considering that one is closer to the water, or one is further from the water, or one is cost more to rebuild and one is cost less to rebuild. And the phase 2 is basically how they're going to determine these rates. So as of April 1st, 2022, all remaining policies are going to be held to the new risk rating 2.0. So FEMA is looking to increase rates on homes who have a higher flood frequency, adjusting your rate depending on your distance to a major flooding source, amending rates due to the value of your home, and increasing rates for higher valued homes due to the cost to rebuild. So you may have two homes or two condos on the same street. One condo building may be made of higher quality construction, and because of that, they're going to be held to a higher value, which will then increase their flood rate. So I'm not sure how fair that's going to be, and I'm not sure how it's going to roll out, but we're going to have to see come October 1st. FEMA has also mentioned that they believe that policyholders with lower valued homes have been paying more than their share, while policyholders with higher valued homes have been paying less. There are currently 5 million policyholders in the United States, and it is estimated that about 3.8 million policyholders, or 76%, will see a rate increase. Policyholders in lower risk areas may potentially see a small yearly decrease. There is a map that we can link back when we send this out to the states that are probably going to see the highest. Just by taking a quick look, it does look like Texas, areas that experienced major flooding in the last few years that the NFIP probably never thought they would, are probably going to see the largest increase. This could probably, really hurt the housing market, if we see increases of an extra $400 or $500 a year attached to what is already, could be considered high premiums. What is a flood map and how is it used? Flood maps show a community's risk of flooding. Flood maps show a community's flood zone, floodplain boundaries, and base flood elevation. So it's basically an overview of everything that we discussed into one. And that allows the insurance companies to determine what is your real risk. Property owners, insurance agents, and lenders can use flood maps to determine flood insurance requirements and policy costs. Because flood risks change over time, the National Flood Insurance Program and the Federal Emergency Management Agency work with communities across the country to identify and map flood risk on an ongoing basis. If a policy was obtained prior to the effective date of the map change, you were grandfathered. Rates can be based upon the prior zone and the BFE. Continuous coverage must also be maintained to take advantage of these rates. The property can also be grandfathered if it was built in compliance with the flood insurance rate maps in effect at the time of construction. So let's say you built a condo building in 2010 or a home, you built it within compliance, although the maps have changed and the rates have changed, you still may be able to take advantage of that rate because you are built in compliance, which is very helpful and definitely something that you should take advantage of. If your building is in a high-risk area, you are likely to pay a higher flood insurance premium than someone in a moderate to low-risk area. The exact amount you pay is based on several things, including the flood zone and the elevation of the building. Just to go back to what we discussed in the last slide about the risk rating 2.0, FEMA has come out and said that moving forward, as far as October 1st, they will not be using flood zones to determine risk. So although they're going to still, map out and assign you a flood zone, they're using different methodologies that we discussed to really figure out what the best premium you should be paying. So this leads perfectly into a private flood company. Obviously there are a lot of changes taking place with the NFIP, and some of the options, especially for homeowners, is private flood companies. They don't conform to all the rules and regulations of what the NFIP wants. In many cases, they're able to offer premiums that are 20 to 30% less, and they don't have all the requirements as far as requiring an elevation certificate that you have to jump through. Their waiting periods are sometimes 10 to 15 days versus 30 days. So there are a lot of benefits of a private flood, especially with all the changes taking place, with the NFIP. So here are some of the benefits of a private flood company that we can just touch on. They can offer better rates due to underwriting guidelines and has the ability to rate properties on an individual basis and not on a community rating, which is what we discussed that FEMA is trying to get away from. In most cases, an elevation certificate is not needed, and there's typically a waiting period of only 10 days versus the NFIP of 30 days. Co-ops are eligible for $25,000 in loss of income with most companies, and higher limits are available rather than the NFIP for co-ops. Co-ops max out at about $500,000, and with private carriers, they're willing to go a lot higher. On the personal side, you can purchase dwelling limits up to $4 million, which in many cases will eliminate the need for excess flood insurance. Personal contents limits up to $500,000. Basement contents coverage up to $10,000, which currently any type of basement content is excluded in an NFIP policy. So having that little extra endorsement can be quite helpful. Temporary living expenses of 75% of your cost up to $10,000, and pool repair and fill up to $10,000. So these are just some extras that these private companies have included to try and attract homeowners and condominium buildings. Here are some of the differences. Co-ops would have business interruption insurance. Business interruption covers you up to $25,000 at a rate of $500 a day for up to 50 days after a 14-day waiting period. So if your building is closed for 64 days after a major flooding incident, you would collect $25,000 in business interruption coverage. Currently, the NFIP does not offer anything like this. Condominiums are not eligible for this coverage. Both co-ops and condominium buildings get up to $4 million. Co-ops are limited to $500,000 with the NFIP. Condominiums do not have to worry about $250,000 per unit, but they still do need to have 80% of the replacement value or the maximum offered for the building to avoid a co-insurance clause. Condominiums must have a minimum of $100,000 per unit in building coverage. There's no elevation certificate currently required for co-ops or condominiums in private flood. Condominiums can get $500,000 of contents coverage as opposed to the $100,000 offered by the NFIP. And as we mentioned before, waiting periods of only 10 days instead of 30 days, unless there's a loan closing, which would be immediate. Downsides is the maximum is only $4 million per building. Because of unit limitations, some of which are 40 units, medium to larger buildings are ineligible. Maximum dwelling coverages for the home of only $250,000, and there is currently on the NFIP no coverage for temporary living expenses. So based on all the information we discussed, why do I need flood insurance? It seems like each year the flood insurance, NOAA says that it's going to be worse than the last year. The Sandy caused over $70 billion in damages, one of the most costliest U.S. storms in history. In addition, the storm had a devastating impact in destroying over 650,000 homes. Flood insurance is not covered by your home insurance policy. Homeowners insurance policies will only cover water damage related to plumbing systems and water backup or overflows. In high-risk areas, there is at least 1 in a 4 chance of flooding during a 30-year mortgage. and flooding can happen anywhere at any time. In fact, more than 20% of the NFIP claims come from outside the high-risk flood areas. So those were some of the zones that we mentioned, the X zones and the B zones. So just because a real estate agent or a bank may say you're technically not legally required to carry flood insurance, an X zone policy often runs, less than $700. So, for that amount, it seems like it's a no-brainer. And that's the end of our presentation. My information, as well as Edward Mackoul's information, is down there. We are willing to take questions anytime, even after this presentation, and we will send a copy of the presentation to Marianne, and she can send it out to all the attendees.
Justin, nobody else has typed in questions, but I have a question. The elevation certificate seems to be an optional thing, but a very important one. Could you give us a little more detail on that?
Sure. So as I mentioned, any of the pre-firmed homes are not technically required to carry one for quoting purposes. But like Cheryl mentioned, it's abundance of information that's on there. And just because you don't need it now and you're a pre-firm building or home, it's definitely something that you should carry in order to really figure out, what your issues are and what areas are below grade, where you can make some changes. A lot of that information on the elevation certificate you really can't find anywhere else. So, for the $800 or $1,000, depending, of course, on the size of the building, it seems like a no-brainer to have an engineer come out and really do a good survey of the property.
And it's done once. You don't have to do it.
Correct. So elevation certificates do not expire. The pictures obviously expire. They have to be done within 90 days, but the actual data and all the information will never expire. You may see your building, elevation change an inch or two, but the NFIP is okay with that, and they never make you get the new one.
Thank you. Well, I've learned a lot tonight. Thank you. It was a wonderful, it was a scary presentation, but a wonderful one, and important things for us to know.
Yes.
My thanks to all of you, particularly for the ladies jumping in at the very last minute and making themselves available. And please give our best to Ed. Thank you all very much for being part of this event.
Yes, thank you, Marianne, for hosting us, and we'll get you that presentation and send it out. And it's even good just to have on file in case anyone ever, has some detailed questions on flood insurance.
Absolutely.